Investing can feel like a roller coaster, full of ups and downs. But often, the biggest challenges aren't in the market itself, but in our own minds. Let's explore some key psychological biases that influence our investment decisions. First up is loss aversion. It's a powerful bias where we feel the pain of losses far more acutely than the pleasure of equivalent gains. Imagine gaining $100. You feel good, right? Now imagine losing $100. That feeling of loss is often twice as strong, or even more, than the joy of gaining the same amount. This can lead us to hold on to losing investments for too long, hoping they'll recover, or to sell winning investments too early, just to lock in a small profit and avoid potential future losses. Next, we have confirmation bias. This is our tendency to seek out information that confirms our existing beliefs and, crucially, to ignore or downplay evidence that contradicts them. If you're convinced a certain stock is a winner, you'll actively search for news articles, analyst reports, or social media posts that support your bullish view. You might conveniently overlook any negative reports or warnings. This bias can prevent us from making objective decisions, leading to poor investment choices based on incomplete or skewed information. Finally, let's talk about herd mentality. This is a tendency to follow the crowd, making investment decisions based on what everyone else is doing, rather than on independent analysis. When a stock is soaring, the fear of missing out, or FOMO, can drive people to buy in, even if the fundamentals don't support the price. Conversely, during a market downturn, panic selling can spread like wildfire, even if it's not in an individual's best long-term interest. While it can feel comforting to move with the majority, the herd isn't always right. True investment success often comes from independent thinking and sticking to a well-researched strategy. Understanding these psychological biases, loss aversion, confirmation bias, and herd mentality, is the first step toward becoming a more rational and successful investor. By recognizing our own predispositions, we can learn to pause, analyze objectively, and make decisions based on sound principles, not just our emotions or the actions of others. Happy investing!